Hello everyone, welcome back to the channel. It's Johnny G here, and I know this is going to sound intense right out of the gate, but what I'm about to walk you through is not doom, fear-mongering, or collapse porn. Think of this as a scoreboard, a collection of numbers and trends that, when you actually connect the dots, explain why so many households are quietly cracking right now while the headlines keep your attention pulled somewhere else. Because here's the uncomfortable reality. The average family doesn't fall apart because of one massive catastrophic event. They fall apart because of hundreds, even thousands of small, it's fine moments, right up until the moment it's very much not fine anymore. And in just a minute, I'm going to show you the exact chain reaction that turns I'm doing okay into I can't breathe financially almost overnight. We're going to connect emergency savings, consumer debt, government debt, and the shrinking purchasing power of the dollar into one ugly, honest timeline that points straight toward 2027. Now, very quickly before we dive in, if you value original research and you're tired of recycled copy-paste finance channels repeating the same surface-level talking points, support a campaign I'm running to clean that up. Subscribe to the channel and drop this in the comments, OG John AG. It takes 2 seconds and it helps more than you realize. Also, make sure you check the description after this video. I've put bonus links there for you, including our premium WhatsApp channel and the channel membership link, so you can stay ahead of these shifts without chasing rumors or reacting late. All right. Let's talk about the 85% claim, what it actually means. Right now, as of January 2026, a shocking portion of Americans have no emergency buffer whatsoever. Not low savings, not a little tight, I mean zero, no cushion at all. And on top of that, the majority can't handle a relatively small surprise expense without borrowing. That's the first domino. The second domino is what that borrowing looks like in 2026. High interest, high stress, high friction debt that grows faster than most paychecks. And when debt expands faster than income, you don't need a recession to break people. One bad week can do it. So let me ask you a question that should make you pause scrolling for a moment. If your car died tomorrow or a medical bill suddenly showed up, what's the plan? Cash or a credit card? And here's another question I want you to answer in the comments. What's the one expense that has jumped the most for you? Groceries, rent, utilities, insurance, something else entirely? I want to see the patterns in your answers. Now, as we talk through this, I want to be extremely clear about something. This is not a personal attack on families who are struggling. The system is intentionally confusing. It's engineered to nudge you toward the easiest option, which is almost always debt. And it's designed to keep you calm right up until the moment you suddenly can't move anymore, because while most people are watching cable news, argue about politics, or scrolling past vacation flexes on social media, the middle class is getting squeezed from both directions. Higher costs on the front end and currency devaluation on the back end. And yes, I said currency devaluation, because inflation isn't just prices going up. Inflation is your money shrinking. Official inflation numbers might look tame on paper, but your real life doesn't run on official statistics. Your real life runs on grocery receipts, rent renewals, insurance renewals, and that quiet moment when you realize you're buying fewer things with the same paycheck. Now, before I show you the government side of this equation, and trust me, that's where this story shifts from stressful to borderline surreal, I want to add something important. If you're actually doing well right now, if you figured out how to build momentum in a rough economy, share your success story in the comments. Even a short version helps. It keeps morale up, and it helps this community see what's actually working in real life. All right, government side. The U.S. national debt is now so large that when people say the number, it doesn't even register. Trillions don't feel real anymore. So instead of treating it like trivia, think of it like a machine. That machine runs 24/7. Every single day it adds billions more. Every hour, hundreds of millions. Every minute, millions. Every second, tens of thousands. And the truly frightening part isn't just how big the number is. It's that the machine is accelerating, and the cost of running that machine is swallowing the budget, because servicing the debt, just paying the interest, has become a monster line item, not building anything, not improving anything, just paying rent on past spending. And when interest consumes a larger slice of the pie, everything else gets squeezed. That's not a political opinion, that's simple arithmetic. Here's the key point most people miss. A debt load this large does not get paid back the way you pay off a car loan. The timeline doesn't allow it. The politics don't allow it. The math doesn't allow it. So what's the escape route? Historically, it's always the same. Inflate the debt away by devaluing the currency. That sounds abstract until you realize what it actually means. If the currency is devalued, your savings are devalued, your salary is devalued, your retirement account is devalued in real purchasing power terms. The numbers might rise, but your life gets smaller. And that's why this doesn't stay a government problem. It becomes a household problem. Because when the system chooses inflation as the exit strategy, the public pays the bill. Now connect this to what you're seeing in everyday life. A massive portion of households are already living paycheck to paycheck. And this isn't limited to low-income families. Even higher earners are getting trapped because the fixed costs of modern life, housing, healthcare, insurance, transportation, have turned into a second mortgage. So you end up with this strange reality where someone earns what used to be considered good money but still feels broke. Not because they're irresponsible, but because the value of money is falling while the price of necessities keeps rising. To bridge that gap, the system offers debt, credit cards, buy now, pay later, auto loans stretched longer and longer, rent-to-own plans for things people used to buy outright, and it works until it doesn't. Because the interest rates are brutal. You're not paying a small convenience fee, you're paying a compounding penalty for being squeezed. Now, if you're thinking, okay, John, I get it, people are stressed. Here's where the story thickens. The same pressure hitting households also hits banks, and banks are the plumbing of the economy. When defaults rise, credit cards, auto loans, mortgages, banks don't just lose money, they tighten credit. When credit tightens, spending drops. When spending drops, layoffs increase. When layoffs increase, defaults rise again. That's the loop, and I'm coming back to that loop later because it directly explains why 2027 matters. But first we need to talk about the dollar. In 2025, the dollar weakened meaningfully against other major currencies, and the outlook in early 2026 isn't exactly strong or stable. In the short term, currencies move for lots of reasons: rates, growth expectations, risk appetite. But there's a deeper issue that doesn't get enough airtime. The dollar's global role is shifting. For decades, the dollar enjoyed automatic demand. Countries held it, trade used it, commodities were priced in it. That created a permanent base of buyers. Even when the U.S. ran massive deficits, the world absorbed the dollars. But that system depends on trust, and it depends on the dollar being seen as the least bad option. Now, competing systems are being built in real time. This is where most people tune out and assume it's just geopolitics that doesn't affect their grocery bill. But it does, because when alternative trade and payment systems grow, fewer transactions require dollars. When fewer transactions require dollars, global demand shrinks at the margin. And when demand shrinks while supply keeps rising, the price falls. In currency terms, that's devaluation. I'm not here to sell you a fantasy that the dollar disappears tomorrow. That's not how reserve currency transitions work. They're messy, uneven, and they happen in phases. But I am here to show you why trajectory matters and why households feel the pain long before headlines admit what's happening. Take the BRICS bloc and its expanding orbit. These countries aren't just talking about reducing dollar dependence. They're doing it through bilateral trade agreements, settlement experiments, payment rails that bypass traditional Western systems. As those rails mature, the dollar becomes less necessary as a middleman. And that brings us to the timeline, because the timeline turns this from interesting into urgent. As this year progresses, rate cuts and policy shifts weaken currency support. A weaker currency makes imports more expensive. More expensive imports create inflation pressure even when demand is weak. That's the nightmare scenario: inflation plus stagnation. When wages don't keep up with essentials, households lose breathing room. Without breathing room, they can't build savings. Now layer on record household debt, mortgages, student loans, auto loans, revolving credit. Then layer on a government that's constantly refinancing and issuing new debt just to keep the lights on. This part matters. When the government competes for credit in a stressed system, it either crowds out private borrowing or forces central bank intervention. And central bank intervention usually means more money creation, which again means devaluation. This is why trying to pick one villain misses the point. People blame corporations, politicians, immigrants, the other party. But the mechanism crushing the middle class is mechanical: debt growth, money creation, and purchasing power erosion. The people who do well in that environment understand the mechanism early. That's why smart money moves quietly, not loudly. They diversify, they reduce currency exposure, they acquire assets that can survive. Meanwhile, regular people, the 85%, stay parked in cash accounts, trapped in debt, and stuck in, "I'll deal with it later." Now slow down for a second. If you're still listening, you're already ahead of most people. Most people avoid this topic because it's uncomfortable. But ignoring it doesn't protect you. So let's translate 85% penniless into reality. It doesn't mean everyone is homeless. It means most people lose resilience. They lose the ability to say no. They lose the ability to absorb shocks. They become dependent on paychecks that buy less every year and systems that tighten during crises. That's why the most important word in this entire conversation is margin. Margin is savings. Margin is low debt. Margin is skills. Margin is multiple income streams. Margin is community. Margin is the difference between I'm okay and I'm trapped. Picture two lines on a chart. One is your income. The other is your essential costs. If the cost line rises faster than income for long enough, effort doesn't save you. You lose. That's been happening to millions of households for years. Here's where things get very real. Systems can survive longer than you expect, but they can also break faster than you imagine. They don't fail in straight lines, they fail in bursts. They look stable until confidence cracks. Then what once seemed impossible becomes normal in months. If you lived through 2008 as an adult, you saw it. If you lived through 2020, you saw it again. Those weren't random events. They were stress tests that exposed fragility. Now we're entering another stress period, except the baseline is worse. More debt, less savings, less room for central banks to rescue without damage. What can policymakers do? In theory, they can slash spending, raise taxes aggressively, or grow the economy fast. In practice, those options are politically painful and slow. So the path of least resistance is familiar. Keep the machine running, print when necessary, and hope the public doesn't notice the real cost until later. That cost is paid in purchasing power. History makes this pattern obvious. When empires debase currency, they're funding obligations they can't afford. First, people barely notice. Then prices rise. Then confidence falls. Then people demand harder money, real goods or land. The official money still exists, but it stops functioning as reliable savings. I'm not saying America turns into a movie plot overnight. I'm saying the mechanism is universal, and the early stages always look the same. So what's the practical move? Not a magic product, a framework. First, protect your downside. High-interest consumer debt bleeds you. If you can reduce it, do it. That interest compounds against you. Second, build a buffer. Even a small emergency fund changes your psychology. It gives you margin. It prevents panic decisions. Third, diversify. If all your value sits in one currency, one system, one bucket, you're exposed. Fourth, build optionality. Choices equal power. Power keeps you out of the worst deals when things tighten. Fifth, stay connected. Information and community matter when things get weird. This isn't fear, it's sequence. Cause and effect. Low savings plus high debt equals fragile households. High government debt plus rising interest equals pressure. Rising supply plus weakening currency demand equals devaluation. Devaluation raises costs. Higher costs squeeze households. Squeezed households default. Defaults tighten credit. Tighter credit leads to layoffs. That's the loop. Now pin 2027 on your mental map, not as a prediction of a specific day, but as a convergence year. Alternative payment rails mature. Debt service costs mount. Households run out of runway. Policy options narrow. That convergence raises disruption risk dramatically. And here's the nuance most people miss. In devaluation environments, not everyone loses. Cash-only holders lose purchasing power. Asset holders with scarcity or cash flow can preserve or grow real value. The exit is always widest before panic. After panic, limits appear. Withdrawal caps, transfer rules, extra compliance. Not because anyone hates you, but because systems try to stop capital flight. Wait too long, and your options shrink. That's why the 85% number is plausible. Not because everyone becomes equally poor, but because resilience is uneven. Many have no buffer. Some have savings that can be diluted or trapped. Only a small group has diversified assets, low obligations, and margin. Add psychology, and it gets worse. Under pressure, people deny. It'll go back to normal. America's different. Then they keep borrowing, keep overspending, and keep assuming retirement works the same way. The goal isn't panic, it's position. Now, quick reminder, members get deeper research, not recycled content. If you want in, hit join or use the membership link below. Also, if you're interested in silver-related success stories, there's a separate channel linked below. Real people, real positioning. Check it out. Action list. 1. Audit your survival math. Know what breaks first if income stops. 2. Cut the highest interest bleed. 3. Build a starter buffer. 4. Diversify how you store value. 5. Increase earning power. 6. Keep your head. Preparation prevents panic. Mainstream media loves symptoms, rarely causes. But the cause is simple. Normal life is being financed. A financed society is a leveraged bet on stability. Early 2026 feels calm. Thin savings, heavy debt. Mid-2026, costs reset higher. Late 2026, defaults rise. Early 2027, policy traps tighten. Watch savings, delinquencies, borrowing demand, and bank credit standards. Preparation beats panic. Pick one action. Write it in the comments. I will dappers. Support original work. OG John AG. Take a breath, stay focused, be early, be calm, be positioned. Subscribe. Drop your answers. And I'll see you in the next one.